With the end of June upon us, 2024's first half is nearly completed. It's been a good 6 months for many investors as the widely followed S&P 500 equity index was trading up nearly 15% year to date through late June. And bond returns have been more mixed. Yields on U.S. Treasury securities are higher in late June compared to the end of 2023, meaning that over the 6-month period, bond prices have moved lower. But over just the past 2 months, bond prices have rallied, driving yields or interest rates lower from levels earlier in the year. But we wanted to talk more about the first half equity market returns and then also suggest a near-term strategy to position for the future. So we'll frame the discussion as a tale of two equity markets. Many of us have watched the impact of the largest companies driving much of the index gains this year. And the term Magnificent Seven, when coined in 2023, at the time reflected the top 7 most highly valued companies in the S&P 500. But another way to analyze the concentration of returns is to compare the S&P 500 index, which is weighted by market capitalization, to the equal weighted S&P 500, which adjusts the index to give an equal weight to all 500 companies. Through late June, while the S&P 500 price increase approached that 15%, the equal weight S&P gain was just 4%, an indication that many individual stocks saw more muted returns. And in the second quarter, which is April, May, and June, the equal weight returns were actually negative 3%, while the S&P 500 continued to move higher. Many stocks have traded lower over the past 3 months, but 2 S&P sectors, information technology and communication services, each rallied more than 10%, driving most of the overall S&P 500 gains. And we attribute that performance to accelerating investment in technology to support generative artificial intelligence, or Gen AI systems. And the Gen AI capital spending that is underway is real and has been more than expected. We also believe this drives excess investor enthusiasm that's predicting success before many companies have proven sustained returns on that investment. And we believe at some point a retrenchment should be expected. So this tale of two markets, the technology-driven rally versus everything else, creates opportunities for active long-term investors. We believe that the bifurcation of market returns has created an attractive opportunity to rebalance portfolios, and this means to trim positions in highly appreciated holdings and to allocate to other holdings that have underperformed. This strategy might create near-term angst if the narrow group of leaders continues to surge, but it is the prudent strategy for long-term investors looking to manage risk. And it's a great way to be active while remaining invested. For specific recommendations and strategies, please contact your D.A. Davidson financial professional.